Welcome to another episode of Inside the Margins, where we look at how global institutions manage and mitigate risk. I'm your host, Matthew Komos, founder and CEO of Ogma Risk and Analytics. And today we have a special guest, Will German, Chief Risk Officer at Equifinance. Will has had a career that has spanned a lot of different areas. We share a similar tenure, about 25 plus years. We don't want to give our age away, right, Will? 25 plus years in the industry, and I'm really looking forward to our discussion. Will, before we get into a lot of details, can you provide a little bit about your background and some of your journey?
Yeah, I'd love to, Matthew. And before I do that, just thank you for having me on. I'm really excited about this. Nervous as well, but mostly excited. My career is, well, we're not going to disclose our ages, but let's say a long and varied career. Mostly only of interest to my mother, or not even of interest to my mother. I spent I spent the vast majority of my career in consulting, and since the financial crisis, that has meant almost exclusively consulting with the banking industry. For obvious reasons, I was a partner on the consulting firms. I spent a lot of time working on credit risk models in that space, with the likes of RBS. Following that banking career, about 10 years ago, I moved. Poacher turned gamekeeper. I jumped into Cambridge and Counties Bank, where I was the chief risk officer, and introduced their first suite of credit risk models there. I then took a slight detour. I actually moved into the public sector and ran the government's Help to Buy scheme for 5 years, which is sort of, people think that's a civil service job. Help to Buy is a mortgage lender. Help to Buy is a mortgage lender. I mean, it's one of the UK's biggest mortgage lenders, or was, but it's still essentially a mortgage lender. So that role there was really bringing some banking expertise, some banking know-how, into that environment. As people in the UK will know, the Help to Buy scheme closed a few years ago. So I moved on from that and currently working with Equifinance, where I'm their chief risk officer. Equifinance are probably the smallest of the big second charge lenders in the UK. They're a tier of very small firms competing in it. A tier of sort of larger firms, and we're probably the smallest of those larger firms, if that makes sense.
Yeah, no, absolutely. So kind of a niche area within the UK market, but
absolutely.
It sounds like an area you all have been doing pretty well at so far. So
it's a fascinating market. I'll talk a little bit about it in more detail, but it has its own dynamics. And it's one of those, was before the financial crisis, it was running at maybe £10 billion of lending a year. So, tiny compared to the more mainstream mortgage market. It then contracted. It went down to £2 billion a year, and is sort of gradually that sort of impact. It's a useful product. It's not for everyone, but there is a very important role that second charge mortgages play in the UK market. Again, I'll come on to that, I think.
Yeah, I think we'll get into that in a little bit. One of the things I wanted to touch on right away, because you kind of alluded to the fact that you spent a lot of time consulting and building models and being more into the hands-on component of risk and underwriting. And I think as we talked about Equifinance, there was a lot more judgmental underwriting happening, as part of just the standard business and operating. So, coming from the analytic world and the more statistically minded, how did you approach that as the chief risk officer, and how have you been thinking about what that model looks like ongoing?
So, I think probably the first thing to say is we're not alone in taking an expert judgment-led approach. In the UK market, there is a very large population of firms, building societies, challenger banks, specialist lenders, but in particular, but also more niche parts, the larger banks, where people are still lending in a much more traditional way. Mm-hmm. You have these whole legions of very experienced, grey-haired, quite expert people doing credit risk in a way that perhaps their fathers or even grandfathers might recognise. So looking at each case on its merits, understanding the ins and outs of the deal, understanding the borrower, the security, etc., but also really understanding those wrinkles in the deal, those things that make it not the cookie-cutter approach. Now, sometimes some firms adopt this sort of approach deliberately, and they do use this manual underwriting to differentiate themselves from those lenders who are using scorecards, using auto-decisioning, really to position themselves as those guys. They have a computer says no mentality. We look at each case on its merits, wrinkle in the deal, that sort of thing. That does lead them to specialising very much more in the niche and unusual cases. So it's the smaller lenders who are doing that. But it is very common in this market. It's sometimes dictated by the sector as well. So certainly I've seen, when I was at Cambridge and Counties, we wanted to build some models for our buy-to-let and commercial buy-to-let portfolios. The data wasn't there. We were simply unable to source at that time, and I don't know if it's changed, but unable to source experience, right sort of default data that we could build and train models on. What we did in that instance was we actually built expert judgment based models. So really just frameworks, for want of a better word, that codified and made more consistent the expertise that we had in our underwriters. And we use them in a decision support capacity. We use them to maybe track changes in the credit profile of our customers over time. But they weren't models in the sense that you and I would have understood them. They weren't empirically based, set in data and statistically proven. But yeah, that's sort of where we are. I wouldn't want you to think that we're holding ourselves out as any sort of standard bearer for this is the traditional way of doing banking. This is better. We're not sitting with our abacuses adding up numbers by candlelight or anything like that.
No.
But what we do try to do with Equifinance in particular, and this is true of Cambridge and Counties Bank as well, and other places that I've seen, is we try and use technology quite judiciously. We don't want to be on the bleeding edge of change generally because we don't have the budgets or the risk appetite to do that. What we do want to do is use technology so where we can remove risk, remove friction from our processes, make life easier for our customers and our brokers. And we do that. We've just launched a new loan origination process platform, which seems to be going down very well with our stakeholders. We are in the process of moving to perhaps a more statistically based way of assessing new loans, but looking at ways that we can use data to optimize our processes. But I don't think we'll ever want to lose that personal touch, that element of manual underwriting, especially around edge cases. And this is sort of where I see the future. I mean, as you and I both know, and I'm sure everyone listening to this knows, models are so powerful, they're so useful, and the larger the market they're in, the more homogenous the market, the more data rich the market, the easier they are to train and deploy. Particular customers are themselves reasonably homogenous, reasonably vanilla. In the smaller, more specialist markets, like the ones that Equifinance operate in, it is harder. I'm seeing the future as maybe 95% of cases will go through a model of some sort, maybe 99% of cases, but there'll always be a role for that expert judgment, to give that personal touch, to be able to consider the often messy lives that our customers lead. But also just to weigh up those edge cases, and to go beyond the data, to be able to challenge the sort of computer says no decisions, particularly where the computer feels like it's giving us something that's irrational.
Yeah, I think you're hitting the nail on the head with the way I think about it is balance. Right. So
yes.
Especially when you look at different asset classes, right? So when you're dealing with more secured, higher valued type products versus a credit card or unsecured personal loan, you have to take a bit of a different approach. You can maybe over index, for example, when you're dealing with credit cards, and you can manage lines where you can control your exposure, and do that much more fluidly. I think with what Equifinance is dealing with, you need to have that balance of, I think, automation technology. And if you over-index on models without that sufficient human oversight, that's a concern. So I'm with you. I don't think we get to a world where it's 100% automated. Frankly, I don't want that world. Even coming,
we'll be out of jobs, so
right, exactly. But it's more, I just think, and I've seen it too often, right, where there's an over-reliance on modeling, technology, automation, we work with some clients now where I think you, as you pointed out, there's a need to understand maybe some of the dynamics of that consumer's life, right? And, most people are not intending to go into debt and not pay it back, right? But life happens, things arise, people get cash flow crunched. There's a lot of different scenarios that happen. And so some of the clients I'm working with, they work in the more like what I would call like subprime, kind of deep subprime space here in the US. Yep. And they often have to, there's a whole component of the human, that engagement, right? So in your world, we kind of have alluded to it, but where do you see risk emerging when there is that over-indexing on models only,
I think, well, probably you're touching on it. I mean, there are things that models have blind spots to. There will always be those very unusual cases.
Yeah.
I can remember a great case, which I won't bore you with the details with, but it came across my desk because it was so unusual. It was completely in line with our policy. All the usual metrics added up. Our models liked it. I couldn't see anything wrong with it, but it was one that just in something nagged. And I actually went to talk to one of our non-executive directors, who's the chair of our risk committee, a very experienced lender, name of John Maguire, long retired now, but a wonderful guy. And I said, look, I've got this deal and everything seems above board, but there's something not right. I think there's something not right. I can't see it. And he had a look and he said, I saw a deal like this back in the 1970s. And this is what happened. And this is where it went wrong. And it was catastrophic and we had to get it off the books. And I would never want to touch this lending again. And I can see all the same things in the deal. And I looked at it and I thought, he's right. And I didn't see that. And you can't build that. You can't, that's the grey hair. That's the experience, that sort of thing. Sure. I think perhaps more commonly, and that's an exceptional case, the risk with models, with over-indexing models. One is just that if there is something wrong with your model design, if there's something your model misses, then you're actually making that systemic.
Yes.
So models are great for making really consistent decisions, but if they're making consistently wrong decisions, then you're building up a problem.
You're in trouble.
Down the track. Exactly. The other thing that you can sometimes see is if the market changes very rapidly, then actually the way the model behaves might change. Now, I don't have a good example of this, so it's a conceptual flaw, but in times where markets are volatile, where the goalposts are moving, where things are changing, if your model is not sort of very alert to that and actually get into your model and say, the loss data that we built this on reflected then, but this is now and the world is different.
Yeah.
Then you do run the risk that you continue to write business that would have looked good in the old world, but is maybe not quite so attractive going forward. And that's a tough thing to manage.
Yeah, I agree. Like one recent example of that, I think in many people that I was working with during kind of the more recent period of COVID, right? We've had this debate about, do we use COVID data? Do we not use COVID data? How do we handle it? We saw a lot of forbearance and forgiveness programs. And so payment behaviors obviously shifted. So that's like a great example where if you don't think through the time frame of in which you're creating a model or even a risk framework, right? Another great example that I think about is, maybe 5 years ago, W-2 income was 95% of what you saw in your population. And now maybe the majority is still W-2 income or, standard income, but now you've got maybe some gig economy workers and you've got that dynamic is changing. And so to your point, if you get too fixated on a specific anchor, that can be really detrimental to, and I think it forces risk professionals to be dynamic and thinking about these types of things on a regular basis. But it's a constant need of model validation, monitoring, ensuring that things are performing as you expected, and then taking action, right? Like when you see something shifting, you better be ready to take action.
Yeah. So do you mind if I sort of ask you a question about that? I think you've probably seen more of that than I have.
Yeah.
I'm thinking of specific changes that I've seen. One was the change in the UK of the tax treatment of buy-to-let income, which was fairly difficult for landlords who are holding properties in their personal name. Now, I think over time you'd see that through the default data, the impact of that change. Actually, if you were alert and responsible, you'd have to be quite forward-looking because the legislation changes. You have a reasonable sort of notice period of that. So in your experience, all governance committees, are they just looking at data? Or actually are they looking a little bit wider, trying to, perhaps look around the corners a bit more and anticipate these changes before they actually hit the default rates?
Yeah, so I think in my experience in the US, a lot of the governance function really tries to look at the data. But I think the overall risk team brings that insight about the regulatory environment, right? So it might not necessarily be the governance team's purview, but the chief risk officer or the head of risk might say, I want you to test these. If this type of legislation comes down, how does that affect the way we approach government? So it might not be part of their day-to-day way of thinking, but I think if you build a great, kind of model risk management and governance infrastructure correctly, you can take some of these things into account. Now, to your point, you might get a good lead time on some of this potential change in legislation. But what's often difficult, right, is, okay, now how do we simulate or what's going to be the knock-on effect of this, right? So we can maybe do some what-if scenarios or some kind of variability in our analyses to ensure that the models hold up. But even that is still assumption-driven until the legislation actually comes into fruition. So it can be a challenge. to try to understand what those dynamics look like until you see data.
No, absolutely. It's slightly leading question, obviously something that's on my mind, but
Yeah.
I think it probably just underlines the role that you can do so much with the model. You can predict the future based on the past with the model, but you do actually need that experience and that
Yes.
wide skill set around the table at some point, whether that's coming from your board, from your non-execs. John McGuire, in my example, is coming from the wider risk team. It's not just data-led. Governance has got to be holistic.
100%. And that's, it's funny because our company motto is driven by data, guided by experience. And so I think I feel like that's a good framework to approach these things. And I did not pay Will, by the way, for that setup.
It does sound like I've been planted, doesn't it? It's genuinely not.
Genuinely not. But I think it highlights that a really important component of effective risk management, right? Because there is value in experience, having navigated challenging economic times or new regulation, new legislation. How do you ensure that it's not just data driven, right? As you pointed out, data plays a hugely important role. Trying to understand consumer profiles, the holistic view of a consumer, what data gives you that insight, all of that's going to always be important. But it's about how do I structure a framework to understand when things are moving, especially like let's talk a bit about Equifinance, right? It might be consumers that might not fit traditional credit profiles, right? So understanding those dynamics, maybe the fact that they have more non-standard employment, life changes, that raises risk concerns, right? So you have to determine, okay, is this person genuinely recovering or are these consumers structurally high risk still? And so you need that data to understand that. How do you go about it? How do you differentiate, those key dynamics that are happening?
It's hard, isn't it? Understanding the customers coming to us and exactly what the situation is. We do as much as we possibly can to get under the skin of the customer.
Yeah.
But all of our distribution is via brokers, and in reality, the brokers probably know our customers better than we do.
Sure.
So we are dependent on the information presented to us. And people use second charge loans for quite a wide variety of purposes. So they're very useful for home improvements, whether that's the traditional conservatory on the back of the house or extension, or whether it's energy efficient improvements, solar panels on the roof, heat pumps, even clean boilers, that sort of thing. People also use them for business investments to take equity out of their homes and that sort of thing. For the majority of customers, all these things, if customers have the option to do so, it's maybe more rational for them to take a further advance on their first charge loan. But there's lots of reasons where they can't do that. Always not the best option. They might face ERCs. It might be coming off a great existing rate or whatever. Or lender may not have the appetite for them. So we do play in that perhaps more prime market, but also I think the majority of second charge loans in the UK are used for credit recovery, debt consolidation.
Mm-hmm.
So we're looking to customers who have had issues in the past. They've maybe had an adverse life event, bereavement, loss of employment, relationship breakdown, illness, and as a result, they've run up some debt. These are people not quite on the edge of financial exclusion. They're still homeowners, of course. They have incomes, that sort of thing. But we are offering them a chance to consolidate the debts to get their finances on a more stable footing and return to the mainstream.
Yeah.
However, some of those customers don't do that. Some of those customers do deteriorate further, and identifying those is hard. Clear indicators. So where customers have got obvious vulnerabilities, so problem gambling, mental illness, sometimes just a combination of high income and persistent debt suggests a customer who's just committed to a lifestyle they can't actually afford.
Sure.
But it doesn't always come through in the credit report or even from customers' bank statements. One thing we often see, and this is with problem gamblers or people with other forms of addiction, is they're very, very clever about hiding their behaviour. So they might have all their gambling expenditure going through a separate bank account. Now that's there, so their wife doesn't see it or their husband doesn't see it. It's whether they have a separate bank account for other addictions, I'm not quite so sure. But let's stick with the problem gambling. So it becomes very, very difficult for us to identify where that is taking place. I think what we're really looking for is where there are these existing issues, where we are in the business of giving a second chance. We're looking for customers who are sort of genuinely sincere in seeking to reset, seeking to recover. So we look at their track records, we look at the recent track record, we look for an improving record as opposed to deteriorating performance, multiple consolidations in the past, that sort of thing. But it is quite nuanced. It does require quite a lot of, going through finance is quite a fine-tooth comb to try and pick up these warning indicators.
Yeah.
And yeah, we don't get it right all the time. One of the things we do learn from is those customers where we get it wrong, and we're able to then look back and say, yes, we did everything right, but still this customer wasn't one we should have lent to, either because their situation has changed or they were high risk to begin with and we didn't pick it up. We see it in our complaints data as well. You know, customers come to us and said, I was a gambler, I hid it from you, you shouldn't have given us the loan. We say, well done, you hid it very, very well.
Right. We didn't know.
And yeah, we do have a responsibility, a moral responsibility as well, not to lend money to people that actually will make their situation worse, which is the case with some of these addiction cases. Sorry, I feel I've gone slightly off topic there, but
no, I think it does, because I think it highlights the importance of looking beyond just credit data. So I think over many years, there's a reliance on credit data as the gold standard, which, it still does a really good job of separating risk. But the reality is, there's a need now for even more in-depth insights. And as you point out, even with open banking and insight to the bank information, you still might not get the best holistic picture, right? So, I don't know if this is common in the UK, but in the US, a lot of lenders are constantly evaluating new data sources and trying to understand what provides that holistic view of the consumer. Can I get data that might be orthogonal to the credit report or complementary in some way, that kind of uncovers some of that behavior? And yeah, so is that a common kind of trend you're seeing? And then how do you think about that relative to the regulatory lens, right?
So is it something you're seeing? Absolutely. I can remember a conversation with a few years ago with the CRO of one of the main high street banks. He was telling me how he was trying to get to Amazon. He was trying to get to Amazon and their seller reviews of SME businesses, because he felt this would be a really good indicator of their creditworthiness.
Mm-hmm.
No surprise, Amazon wouldn't let him anywhere near that data.
Well, that's good to hear.
No, never. Yeah, so we're all customers, right? But I think it just highlights your point exactly. Boys on the lookout. We're in conversation with some really interesting companies at the moment about other data sources that we might be able to bring in to enhance our lending. We've also run a number of trials with other data sources. And I think what I've learned from this is you just have to be curious. And you have to accept that you're probably going to have to kiss a lot of frogs. One of the things that so I don't want to talk about what we're doing at Equifinance, but one of the things I did in government to help the buy scheme is, before I arrived, under the Digital Futures Act, I can't remember what the legislation was, but a new piece of legislation came in that enabled extensive data sharing between government departments. So we thought, brilliant, we can actually go to HMRC, we can get some verified income data about our customers, and we can start to make better decisions about them based on this. The theory was absolutely fine. What we found after spending much too much money and much too much time on this was actually the data was not usable. It wasn't something that we could consume and use effectively, both because of the quality of the data itself, but actually more personally because of the timing of it. The data that HMRC was gathering was, by its nature, it was 12, 18, 36 months out of date, whereas we actually needed up-to-the-minute information. A smarter leader there would have realised that we were never going to be able to use that data. As it was, we took some time to get to that conclusion, but we couldn't use that data. But we're always hopeful, and we need to remain hopeful. Look at new data sources and see if they can sort of move the dial for us, if they can enable us to get more predictive about what is a good customer versus what is a customer who we don't really want to be lending money to.
Yeah, it's so interesting. So, having done many different data studies and analytics and working with customers to onboard new sources, it is tough because sometimes you have to go far enough down the road till you hit the dead end and you go, oh,
Yes.
shoot, and it's one of those unfortunate realities of evaluating data sources and trying to gain more insight. But I always say, it's better that we make the attempt and learn than not attempt at all, right? Because I'd rather understand what the limitations or possibilities are, even if at the end of the day we figure out, oh, you know what, we can't use this. At least we kind of made that effort, because I think, and this is actually going to lead into my next area of focus, which, you sat across all three lines of risk. And I think sometimes what we see from a disconnect standpoint, and the data piece is one component of this, which is the operational reality of running a business, right? So oftentimes, right, you'll see board level or head of risk level risk appetite, and that can collide with operational realities, like trying to figure out what new data source works well, as an example. So what are some of those common disconnects you've experienced or seen, not just at Equifinance maybe, but just across your experience? I mean, like I said, you've worked in all three lines, so I'd imagine you've come across this quite a bit.
Yeah, it's a great question. The example in government about their HMRC data perhaps illustrates some of the challenges that we see sometimes. I think your approach to embracing new data sources and being prepared to fail with them is exactly the right thing. You need to be curious. We need to be curious. We need to be prepared to experiment, and also prepared to say, okay, this doesn't work. Let's fail fast. Let's move on to the next opportunity.
Yeah.
Actually, what I experienced in government using this data is when I took over the Help to Buy, we looked at this data. We quickly realized that we should stop the project. We shouldn't spend any more time and money on it. And we made that decision. And that was great. That was endorsed by my board, that sort of thing. What we didn't fully comprehend is this was a bit of a flagship project for some parts of government. There'd been quite a lot of investment in it. There'd been quite a lot of, I say publicity. It wasn't on the 9 o'clock news, but within government, this is how we're going to use data going forward. Isn't it wonderful? I probably spent more time and effort explaining to various subcommittees and parliamentarians why we'd stopped the project, why we'd spent the money that we had done, what we'd learned from the project, etc., than we ever did on the project.
Right.
And that's part of the environment. It's very difficult to fail in government, which is why you often see inertia in government. It's much safer to do nothing than to do something bold and for it not to work. And so there was a little bit of a disconnect in the governance there, not because of bad actors, but simply because of the nature of the committees. Obviously, you're spending government money. It's got to go through due process and scrutiny. And part of that is having decisions questioned at the appropriate level. But I think we probably did encounter a number of boards, perhaps populated by people who were bringing their personal risk appetites into the equation, allowing their personal agendas, whether that's political for elected representatives or whether it's career aspirations for civil servants who are judged on being a safe pair of hands and not being associated with failed projects. The question was all about where's the value for money for received this? And that's the wrong question. The question of the value for money is in what we've learned and in stopping the initiative when we did, rather than the conclusion. So that's a slightly waffly example. I think really the great leaders I've worked in my time, they're the guys and women who can balance risk with commercial and strategic objectives. Those are the good ones. The bad examples I've also seen is when leaders sort of allow their judgments being clouded by their personal objectives. That's when you start to see poor decision making going on. And there's some real danger for people in risk because we are in the weeds all day long of what can go wrong, how things can go wrong, how much it's going to cost when things go wrong, what's really gone wrong, how we're going to fix it. It's very easy for that to become almost the blinkers that frame your worldview. And so you naturally become risk averse. You start to implement solutions that try and anticipate every possible situation. But then because they become disproportionate, because they become gold plated, they actually stifle operational effectiveness. They stifle people being bold and actually being prepared to get things wrong in the short term, in the interest of getting things right in the long term and learning from it. I've often said that, and I think I'm not the only one to say that, I think it's a bit of a cliche, but actually most organisations, the real CRO is not me, and it's not you, it's actually the CEO and the board, because they're the person right at the point of balancing risk and commercial objectives. I think in my experience, actually sitting in that chair at the Help to Buy scheme has taught me a lot, has maybe helped me learn to be better at it. And there's no precise science, Imagine, but it's helped me to understand the perspectives of people who are sitting in the first line, who are responsible for the organisational objectives. One of the things we did at Homes England, which was the sponsoring body for Help to Buy, was all the good decisions we made. Everything was looked at through the filter of, is this going to help us achieve our strategic objectives? Which in that case was get more homes built, get more people into home ownership, all that sort of thing. And that was really helpful in focusing on what was really important.
Yeah.
We did make some very good decisions, but also we made some less good decisions. And the less good decisions were perhaps a bit more about, we're very focused on this issue because it's close to our personal experience, or it's a pet subject, or it's a political decision. And we made less good decisions where that was the case.
Yeah, it's the classic, like, varying levels of what I like to term as profit motives, right, with a given project. So everyone has their own profit motive oftentimes. And, and sometimes the role of the CRO is trying to get everyone to row in the same direction and, right, ensure. I think sometimes in risk, I think we can often be seen as the no people, right? Like, they're putting the stop gate on everything. But I don't think that's really true of effective risk managers, because, the best that I've seen and experienced are teams and leaders that are actually trying to figure out how to say yes, but in a way that is done in a, very thoughtful, methodical, and with the risk in mind, right? How do I do these things while mitigating risk and not becoming a bottleneck, right? Or not stifling innovation. But if you have the right framework and mindset, and I think, as you point out, if you create the right risk first culture within an organization, you've got everyone in that same mindset, and it becomes much easier, to get buy-in, to have those diverse perspectives at the table discussing the best way to approach things to mitigate risk, but also not stifle, moving forward, innovation, etc.
I think it's actually right, Matthew. I mean, risk, if you go back to its etymological root, risk just means uncertainty. It doesn't mean
Yeah,
bad things can happen. It means outcomes are uncertain. So risk can be
right,
good. And we'd lend money accepting that we're taking a risk by doing that, but we're prepared to accept that uncertainty in
right.
exchange for a future return. And I think risk appetite's really important here. I can bore on about this for hours, so I would try not to be too dry. But risk appetite is the organisation saying that this is what we want to achieve. This is how much resilience we have. So based on how much resilience we have and where we're going, this is how much uncertainty we can accept
We can accept it.
on the journey. Now, obviously, organisations don't always follow their risk appetites. And that's a question of culture and governance and that sort of thing. I think what is harder to deal with is when people impose their own personal risk appetite, their own personal profit motive, to use your term, on the
Yeah,
organisation's risk appetite. And so they act in line with their gut feel as opposed to the organisation's goals, objectives, and there are organisations out there, because some of the big tech firms, they've got pots of money, they've got pots of resilience, and they say things like move fast and break things. And obviously bankers hate that. Um,
yeah,
that's
right.
saying, we've got all the resilience in the world, so we've got the risk appetite to do uncertain things like invest in meta glasses or whatever, in the belief that will get us somewhere better in the future, maybe several years in the future. Banks and lenders are perhaps more constrained. We don't do crazy things like that, but we do have a certain amount of resilience for either bad loans or operational risk events. And so we're able to say, okay, we can accept this amount of accepted and unaccepted losses. That's how the system should work. But then you often see, I don't know, you'll see a chief risk officer who's been badly scarred by an enforcement action around suitability or around financial crime or something like that, a lumpy event like that. And so they become, it's not a blind spot, it's a spot of hypersensitivity.
Yeah,
Um,
right, right.
and you find that while the organisation might say we have a risk appetite of X, the person or
They're
people,
saying, you know what, it should be at Y.
yeah, it's Y. So
Yeah,
that's how we're going to behave. And that's, that's not just CROs, that's non-executive directors, that's directors of business units. We've all got biases, we've all got blind spots. Risk appetite should be a way of not ironing them out, but making sure we're all singing from the same song sheet about how we're going to behave.
yeah, and see, it's interesting because I think those types of discussions, like, I want the chief risk officer, rather than kind of going down their own path because of that experience they had. Because, to your point, we're all shaped by our experiences and, what we've been through. as risk managers, risk officers. But I love when you actually bring that transparency and have that discussion and just say, let's start with a baseline risk appetite and let's talk about why it might be different or we should change it
Yeah.
rather than to your point, like managing things to a different baseline and not having any kind of transparency about why it's happening. And sometimes I feel like with complexity that can become kind of creates some of the challenges. I think when we spoke initially, you talked a bit about simplicity as a strategic choice, right? And I think sometimes when we think about lending and risk frameworks, simplicity will often, drive things correctly in a way. From your experience, why does that unnecessary complexity creep in, to our lending and risk frameworks, on a regular
I
basis?
think it's human behaviour, isn't it? And risk
Yeah,
frameworks are established by risk
surprise
people
you.
who are naturally risk averse, and shaped by experience. So you'll set up a risk framework and you'll set up a set of controls, and then something bad will happen. You'll think, okay, we didn't anticipate that. So you build in another control, and then something else bad
Hmm.
happens. You build another control, and it builds up and builds up and builds up. I saw a great example very early in my career of this particular operational process, which had failed in this firm in quite a high profile way. So the firm was in enforcement action with the regulator in the UK because of this failure. And I and a team went in to have a look at it. What we found was that this single process, it had 7 different sign-offs by different parts of their business. Well, they were a large business, but everything that went through the process, it was signed off by their actuarial function, it was signed off by their lawyers, by their operational functions, by the product team, by several other people, a compliance team, I forget who else. So you think, wow, nothing's going to get through this process that's not
Right.
100%
Uh,
wonderful. I mean, nothing did get through that process in less than about 6 months, but that wasn't the issue they faced. What was actually happening is because everyone knew that everyone else was looking at it, they were almost nodding things through. They weren't
yeah,
looking at
say
things
nobody's double
properly.
checking.
It's exactly so. Doesn't matter if I slack off because Matthew will pick it up in his check.
Right.
And so this vastly complex, vastly over-engineered process, which should have led to there being no risk, was actually producing really bad
More risk.
outcomes.
Yeah.
And we tested it. We tested the outputs, and I think we saw about 40% of things coming through had things materially wrong.
Wow.
And
Wow.
it really didn't need to be like that. And this is the joy of working consultancy. You get to go and look at the problems and fix them and say, hey, wasn't that brilliant? Why do you think of that? When you work working in the organization, you do sort of think this is how we do things. But we fixed it. We re-engineered that process, and the error rate dropped to less than 5%, almost overnight. What was more meaningful for the business, apart from getting the enforcement action quashed, was they could get things through. I think they were taking 48 hours, typically 72 if the key people were out of the organization. In terms of managing risk better, it was hugely impactful. But in terms of a business-driven efficiency, it was absolutely revolutionary.
That sounds like a very interesting case study, or make a great case study.
I've
Right.
been using that case study for 20 years, Matthew.
Well, and to be transparent, I've come across very similar situations, and so it's probably especially for us consultants, right? It's a common story because of the fact that, as you point out, there's human nature involved. I really love that idea of potentially getting into a sense of complacency, actually creating more risk because, or the idea, and one of my other guests talked about that idea of, well, it's always been done that way. And so there's never a challenge to how things work because it's always been done that way, and we talked about how that creates kind of a myopic view of like how to approach new problems or existing complex processes that don't need to be so complex, right?
Yeah.
So yeah,
And the biggest challenge in my experience in risk management is buy-in. Is actually get the organization to commit to it.
yeah,
And now what happens is when you build a control framework or a process that is so engineered, that's so difficult. I'm sure we've all seen policy documents that started off as 5 pages and readable. And over the course of 5, 10 years, they become 50 pages monsters. Who reads a 50-page policy document? I
yeah,
do because I'm boring,
yeah.
but
I was gonna, yeah,
real people
but
don't.
but yeah, normal people don't, but will.
Yeah, we love it. But then we're surprised when people don't follow the policy. On
Yeah.
page 73, it said this. Why didn't you do it? Well, it's because it's on page 73.
Because it's on page 73. I made it to page
Yes.
6.
Yes.
Yeah,
So yeah, I
exactly.
mean, if you genuinely want people to buy into risk framework, you just need to think about your audience. You need to make your rules, your framework, your procedures clear, so everyone understands them, accessible. You need to make people accountable. This is really important. So
Yeah.
that's important, but also they need to be proportionate. People need to look at them and think, okay, it's going to take me 10 minutes to do the right thing here, but actually I can see it's important and that's the right thing to do. Whereas if they're saying, wow, it's going to take me 3 hours to do the right thing here and I see no value in it whatsoever, so then they'll take the shortcut.
Yeah. No, that's well, it goes back to the point about aligning, kind of incentive to profit motive as best as
Yeah.
possible, right? So you get those outcomes. Well, I feel like we could talk for hours on any number of topics. But I do want, before we close, this has been a great discussion, Will. I mean, just talking about, judgmental underwriting, some of the considerations with automation models. How do you think about it? Regulatory, governance, risk frameworks, appetites, it's so many important components of, being an effective risk manager, chief risk officer. Any pieces of advice you want to leave the audience with, about that concept of balancing judgment and automation in modern lending, how to think about it in the context of the regulatory authorities, anything that kind of you want to leave our viewers with?
Gosh, that's a tough question. I mean, I've really enjoyed the conversation. It has been quite wide ranging. So what are the closing remarks? If I might, we've not really touched on this, but if I might, could talk about the regulator a little bit.
Yeah, absolutely. Absolutely.
Because adopting a judgment-led approach to models is the way that things have been done in the past. So, and regulators are comfortable with that. In the UK, at least, I can't speak to other jurisdictions, but our regulators have always been very outcomes focused. They've been very principles focused, and if anything, they've become more principle focused over time. When I was starting out, there still is a framework of rules, but throughout my career, the FSA, then the FCA and PRA subsequently have become more and more vocal about the rules say this, but actually the spirit is more important than the letter. So if you think that there are safe harbours, if you think you can follow an operational process where you don't break any rules, but actually you're acting in an unprincipled manner, you're causing bad outcomes for customers, you're destabilising the financial systems, that's not good and we'll find a way to get you. They don't actually frame it quite like that, but that is very much the message.
Idea.
That's the message, and everything, all the big things we see in the regulatory space, whether it's treating customers fairly, more principles-based regulation, consumer duty, it's always different ways of saying the same thing.
Yeah.
So what's important for this is you would expect that a data-led, model-led approach to underwriting would give you very, very consistent outcomes. And if you design your model effectively, it'll give you good outcomes for customers on a consistent basis. If you're using expert judgment, either underwriting cases individually or judgment-based models, then you do need to be a little bit tighter on your governance, making sure that you are driving that consistency in the system. And you do that for all the usual boring stuff, through QA, through training, through monitoring, etc., etc., etc. What does happen is, I think I said at the start, that the way that manual expert judgment based underwriting processes take firms into markets that are more niche, that are more specialist, and where there are more wrinkles to the deal. So whilst those cases might not be inherently higher risk from a credit perspective, there is much more risk in your operational process. There's much more operational risk in your underwriting process. And regulators are very alive to that. So if you are going to use manual underwriting or expert judgment based models, you need to be damn sure that you've got the right controls in place around them, because you are dealing with customers who, in Equifinance's case, they're probably more vulnerable than mainstream customers. They have more complicated lives. They have more going on. Getting into that properly is really important. And if you don't, the regulators, I think the FCA is doing a brilliant job. And the FCA has actually gone out of its way in recent times to really understand the second charge market in particular, and specialist lending more generally, in fact. They're doing that, and their recent thematic work is really useful. I think that the Financial Ombudsman Service, who is an independent adjudicator for customer complaints, probably still has some way to go in that respect. And so there is some wrestling that's going on in the UK with those regulatory bodies. But that's probably my closing thought. other than thanks so much for having on. I've really enjoyed this, and yeah, best of luck for the future.
Thanks so much, Will. And yeah, it's interesting. If you think about and I would say in general, what I've seen in other jurisdictions as well, just to finish up on your closing point, regulators are becoming more and more open to different ways of approaching problems while ensuring that, the best interest of the customer is taken into account, et cetera. So to your point, right, if you rely on more judgmental or manual process, you better have good controls and make the regulator comfortable around that. And then as you move towards more automation and data use, you might get that consistency, as you mentioned, but you better be transparent about how you're making those decisions, right? So it goes back to something we touched on earlier, which is that idea of balance. And I think if you work with the regulator in harmony, then you will strike that balance. I'm seeing it, in other jurisdictions, like I said, and so it makes some aspects of the life of a chief risk officer a little easier, just knowing how to approach these things. So, well, thanks again for your time, Will, and thank you all for listening in for another episode of Inside the Margins.